Right, hopefully, for guys online, we are back. Talking about three soldiers, three crows. Ultimately, this is a great way of giving you a clue as to what the next day is going to be. My prediction of the next day, if I see something like this, is a candle that looks a bit like that. Something reasonably small, might consolidate across the high, might consolidate to an inside day, but ultimately I'm going to expect a consolidation. I'm going to expect volume to dip off on that day as well, just because of the fact that you have had that very strong move up. It's something that I do feel does work quite consistently. Now, I'll show you an example in a bit. The key thing for me when you do get something like this is to maintain the bias. I have often heard people say that this should be seen as a reversal type pattern, that's going to call the end of a move. For me, I feel that you should maintain the bias because, like I was just saying whilst we were offline, it's unlikely that a market stops and turns like that on a daily or larger time frame basis. It might on a short term, it might do it on a 1 minute, 2 minute, 5 minute chart where you get a straight line down followed by a straight line up. But it's less likely on a daily that all of a sudden, out of nowhere, everyone's decided actually this is a sell up here and this is going down. Once it starts to go down, then people decide it's a sell, then people join in. So expectation wise, small range day, I would then always play that in this context as a buy. So I'd always be looking for something to pull back, to give me a place to get in, give me an opportunity to buy it. My expectations are not going to be much. I'm not going to be, say you get a dip back down towards, I don't know, the VPOC or something, you get a buy back up. I'm looking, because I expect this to be a consolidation day, any dip I buy, I'm looking to play it back to the middle of the range, expecting this type of day. I'm not going to be buying a dip thinking, yes, we're going higher, because it's probably going to lead to disappointment. You're going to end up buying it here and you watch it go onside back, onside back, onside back, onside back. Where do you get out of that then? Because you've invested in it for so long that you feel you should get paid more for it. At which of these highs do you give up, or do you end up giving up as it comes down because you just don't think it's going to work anymore? So it's a way of managing your expectations. It's a way of managing your time on a day like that as well, but also your bias. And I think the bias is so important. Same with after a very strong up or down day. My expectation often is a bit of consolidation, but always with the bias in that direction. What it does is it prevents you getting caught if the market does decide that it is going to have another go. We've got a nice little example here. So Bun's quite good for it. Bun really likes when it takes a trend day, that it would often trend. Not so much in the DAX, although there are some examples which I'll come on to. So you get a couple of nice ones here in the Bun. You get 1, 2, 3 soldiers there. Inside day, harami, break. We close back inside the inside day, and that's what really catches people out. Because the next day, even with a close back, so sort of a failed inside day breakdown, we then sell off and you get 1, 2, 3 down and consolidate once again. And you note each one of these consolidation days, so after these 3 down and the gravestone doji or inverted hanging man, low volume, low volume, low volume on each day. So if you maintain that idea or that expectation of a low volume day, what you don't get caught doing is getting overly convicted, start thinking, yeah, this is going to keep breaking the high, this is going to do loads today. You can very quickly settle back down and go, okay, we're going to see something reasonably quiet today. Not too much is going to go on. I don't need to go crazy today. Manages your expectations, manages your trading a bit. And yeah, very nice example in a Bun. Like I say, the Bun does seem to quite like this. Bun will quite often have a reasonable range, followed by a reasonable range again, and often followed by it again. Equity markets are a little bit less keen on this. DAX, I've got a slightly more extreme example because, again, this is the recent one. But they can often have, particularly if it's a little bit out the blue, large day, you will then get a smaller day the next day. But nonetheless, DAX, and this is where I think we're very similar today as a reason to go higher. Rejection candle, 3 up, 2 very tight days. I'm not going to argue that that's 3 crows back down there. And you see it again here that you don't get the 3 in the DAX, but nonetheless, if you played this day from the bias of a sell, you're not really going to get yourself in a great deal of trouble. Yes, we end up with a green day, and this is where you've got to be patient and let it come back up, let it find a place to sell, then sell it. Don't try and guess the sell point. And also manage your expectation of how far it's going to go. It just broke the low. So yeah, if you've been sitting there all day waiting to play the break of the low and sell that, that's the kind of trade that's less likely to work. It's more a pullback situation that you want to be looking for. Do you have a question? No. So yeah, that's the DAX. Again, another example of decent range extension day followed by very small range day consolidation. But again, this one does move higher, so maintain that bias. But you want to maintain it from the point of view of looking for a pullback to buy, not looking for a breakout. Right, and the big reason why you maintain bias is because this is the FTSE, 5 down days in a row. If you go the other way and start saying to yourself, yeah, but this is going to be a consolidation day, I'm just going to buy dips, so I'm going to sell it as it goes up, you end up buying it on this day here, going, yeah, but it's going to bounce, it's going to bounce. How far has it got to go before you decide it's not going to bounce? And then not only have you gone the wrong way on a move, you've seen a pretty large down day, which has probably been quite a sort of active down day, volume sort of picked up on it. Reasonable day to trade if you were going the right way on it. Yeah, it would have often given you opportunities to get short. It would have pushed you on side, it would have shown extension, it would have kept you in trades. But instead, you've been buying this all the way down because you decided that we're definitely getting consolidation. So whilst I expect consolidation, by at least playing it from the short side, if it does start to go, if it does start showing that, you know, perhaps it creates a pattern to go lower, volume starts picking up against what you expect, and volume does, you know, these 2 days here, do you get reasonable pickup in volume? Volume starts picking up, you then at least save yourself going against it and may well be ready to sort of pick up on that change and go with it. So that's why, like I say, I would always keep to the bias, particularly on this one here, that even though you've seen 4 down days now, you then get a gap, and we're very close to this most recent low, which is 72.76, which is an area I think we could get back up to in the next few days. But with a gap down, you've then got to be thinking, if we don't get back to that gap, this is going to the downside. Break 72.76, and then we get this proper sell-off. So that's why with those 3 crows, don't get too caught out. And like I say, I think the Bund plays it a little bit better than the equities in terms of being a little bit more consistent in continuing the move. Right, Marabuzos that people were talking about. Euro stocks has done it rather nicely in the last few days. This big green candle, I would definitely say it's Marabuzo. What I've got here is the gold bar is the ATR. The hollow blue is the range on the day. So obviously if you can see the blue, then you know it's at least above average day. some of these exceptionally above average, so these two in particular, and that's where I'd then be looking at the Marabuzos. So this green one, open to close range was 330 to 470, so 140 ticks, halfway 70, add it on to the low, or sorry, to the close, sorry, add it on to the open, because the open's at the low, or you can take it off the close, whichever way you want to do it. Find that midpoint. It was 3,400, the low, 33.97. So if you played that Marabuzo, worked rather nicely. Like I said, I'm more keen to play it as a sort of short-term scalp type trade as opposed to a much bigger trade. And we ended up with this complete doji. So if you did sort of play it for a continuation, you didn't get the continuation. You just got to shift back up the range. Again, a couple of days ago, so Thursday, smaller range, you got an 89 tick range. Midpoint, or the Marabuzo of that, 33.82. And that is currently the high of today, where we had 84 was today's high. So we've had a reaction from it. Where are we trading now in these stocks? 70. So, you know, we come off 15 ticks. Yes, it's been very slow. Yeah, you apply this to a different market, you'd be given a little bit more, a little bit quicker in it. But perhaps does give you sort of a reason for it to stop at 84. If you look at candlestick chart, you know, what's at 84 really here? You've got smaller levels around these areas, but there's nothing that clear. Maybe 97 from this old dip lower, you could see why the market would stop there. But we stop at 84. There's that trend line as well in the stocks. Stop at 84, we've backed back off it. So like I said, I don't necessarily expect this to run back through the range. We've already had our dip to the close. So I'd just be expecting to play this back into the range. You know, perhaps if you can go to the midpoint, perhaps if you've got sort of a smaller level somewhere that makes a bit of sense on a shorter time frame chart, that's where I'd be looking at for the target on this. So it's more a sort of scalp type trade for me, or a target if you're long. Yeah, if you're long, you bought that close, that's where you can go, right, I'm going to have a little target at the Marabuzo, at least to take some of your position off rather than getting caught trying to run it all the way to 97s, and now you're sitting there long at 50 is trading 70, and you started thinking, this isn't far off the midpoint of the day now, so if we start getting back below the middle of today's range, are we then going to have another go lower? That was a nice reason to sort of get yourself out and give you an out on that trade. So yeah, that's your Marabuzos, Peter. A decent sort of target, I feel. As I say, more a target than a place I'd be getting in and trying to run a trade from. Right, with candlesticks, key considerations all the time. Time frames, bigger candlesticks, more important. Bigger candlesticks going to give you bigger stops. That's the consideration. So larger candlesticks, I'm using that as a bias generation. Shorter time frames, yeah, you've got a better impact on your risk. You can be much more you can be much more accurate in accessing your trades. Yes, they're slightly less likely to work because less people are looking at them, but it's all about using what you can see from the larger candlesticks. That tells you your story. Your shorter term candlesticks tells you what to do about it. In general, looking at ranges, small range candles show little energy. You start seeing ranges in candles dipping off, expect your frequency of trading to do the same. Large ranges can either show a breakdown in a pattern or a breakout of a new pattern. So that's the kind of candle that you want to be looking at for some kind of change. So large ranges, but also increases in volume on that. If you've just got a massive range candle that's perhaps done, particularly if you're looking at US markets that's done out of cash hours in that sort of overnight Asian session that sees usually very low volume, you get a particularly large candle there, chances are it's been a load of stops getting taken out in the middle of the night. It's not telling you as much as it perhaps might look like it's telling you, and that's where volume's very helpful. With all candles, when you're starting to take on a trade with them, think about what happened before it. Yeah, are you looking at one candle in isolation, or are you looking at what's happened before? That context before it makes such a big difference. Always think where you're going to place your stop. Generally, you can have your stop beyond that candle, particularly the rejection candles that give you a nice clear point that they've shown you where your stop can be. So if you've had a rejection up and down and you sell it here, that's where the rejection was from. So if you put your stop above there, theoretically you should be.
Do you have a rule of thumb for how many ticks stay above that level? You know,
above, I think it varies by market, but if I'm playing something like that, like a rejection one, not much at all, like 3 ticks maybe.
But at least a little cushion as well.
Yeah, what I wouldn't do is have it on or 1 tick over, because so often a market will go up and someone who's long will go one lot into the next price just to see if they can get a stop to go off. And you can do it every so often. You might get lucky, you buy one more and you hit the stop and it goes ping straight on side for you. So yeah, I'd never have it 1 tick over the level. 2, 3, 4, 5, depending upon what market it is. Yeah, I think something like DAX or currencies a little bit more likely to just flick through just to see if there's anything there. Whereas say the Bund, if it goes up, rejects and then starts ticking through, I don't really want to be in that. More 3 ticks I think is enough to tell you that certainly the rejection trade's wrong. You might get another rejection and you'll be frustrated at losing the 3 ticks, but the trade that you're playing for is wrong at that point. Only big issue, and we'll come on to this in the afternoon, candles don't really give you targets. They'll give you a reason to be in a trade, they'll give you a place to get in and a place to put a stop. You're then going to have to look at the bigger picture of what's been going on to give yourself a target. So an individual candle won't do that for you. And that is about it for candlesticks. Anyone got any other questions on candlesticks? I'm quite a big fan of them in terms of, I think most of my ideas come from a candlestick. Profile gives you the timing and the general idea of what the market wants to do. Candlesticks is what tells you where the breaks are, where the specific points are that you want to be entering and exit are. So pretty important. Afternoon, we'll go and have a look at candlestick patterns, how they play out, how you want to trade them, again when and where they're better used. All right, we'll come back at 1 o'clock. There's nothing out today, so no need for trading anything at 1:30. So yeah, we'll come back at 1. Candlestick patterns. Right, see you all in an hour and a little bit.